Spotify is a company that's caught my interest over the last week or two. It's a stock that I think has got some good growth potential, but at the same time isn't too risky of an investment. And this is because Spotify have around a 35% market share of the online music streaming industry. And given that their model is subscription based, investors, institutional, retail ones as well, they'll see this as an occurring revenue stream, which is pretty much king in the 21st century. And so what I want to have a look at is the financials, the technicals, look into it a bit more. I think this has a really good future, this company. This is my personal opinion, so please don't take this video or any previous videos as advice or guidance. My name's Tyrone, it's the 12th of July and you're watching Mini Pip. Jumping straight into the video, I want to look at the financials first. Now, Spotify has a market cap of 41.1 billion. Last year, we saw turnover of 9 billion with a loss of 809 million pre-tax. After tax, it was 663 million, so they got a subsidiary of 146.2 million, essentially like a rebate, or however that be, in the USA. Now, one of the things that interests me with this company is when we break it down in quarters. Now, they've only been public since sort of 2018, so there isn't all too much data available in terms of going back on the yearly, but on the quarterly, there is quite a bit of data that we can look at, and we can see continuous growth. And if we look at the most recent quarter, I'm quite excited because this quarter they've done 2.5 billion, just short of 2.6 billion turnover, with a $27.7 million profit. Now, every other year, last year, apart from the first quarter, was $1 million profit. But then you can see it's been a very, very mixed bag of profit and loss. And so what I'm hoping is that this Q1 here of 27.7 million in a profit can continue. And if this can continue, provided that your growth, your revenue is growing, I'm hoping that now we're getting to that point in Spotify where we can start to actually turn a profit and make money. Now, if they can continue that growth, you're looking at around 10.2 billion turnover this year with a $110 million profit. They haven't actually done a profitable year while they've been on the market. I haven't checked previously to see if they've had a profitable year when they was private. To my knowledge, I don't think they have. But if they could have one profitable year, or this year be profitable, it's going to make a huge difference to what investors think about this company. And with it being July, earnings season is starting, and Q2 results, I believe, are due on the 28th of July. So on the 28th of July, we're going to get the second quarter, and on the second quarter, we're going to be able to tell sort of what they've done in the first half of the year. If they can continue that into the second half of the year, we'll get more of a understanding and more of an accurate picture of what they could do sort of July to December of this year. And if they can turn a profit, I think that this stock's got a lot further to go from the financial side of things as well. Now, looking into the balance sheet on the most recent quarter, we've got a huge jump in cash available from 2 billion to 3.7 billion. Receivables are up or thereabouts the same. They're up about 2 million from the previous quarter, with total assets 9.6 billion. They're up quite a lot, to be fair. And liabilities are $5.7 billion. Now, that leaves Spotify net positive 3.9 billion, and it gives them a ratio, a liabilities to assets ratio of around 59.6%, which is average, so between 50-60%. That's what I like to see. So basically, how much debt is coverable by the assets. If you see negative liabilities, or in my opinion, if I see negative liabilities on a balance sheet where there's more debt than assets, profitability in a company is really important, because if they don't make money either, then it could end up being a downward spiral. But in the case of Spotify, but the income statement looks to turn a profit, and I'm hoping that they do make a profit this year. However, even if they don't turn a profit, they've got a lot of money available to, subsidize a $400 million loss when you're sat on 3.7 billion. It's a similar situation to Airbnb. Airbnb is being screwed over a bit by the pandemic, but they've got the money to afford the loss, and it's the same here with Spotify as well. So overall, financials tick out. I'm happy with the balance sheet and I'm happy with the income statement. There's no problems there from what I look at. If anybody wants to know the site that I use to find this information, it's Macro Trends. So overall, the financials are good. You've got a solid revenue, you've got a solid balance sheet. Revenue is increasing and the balance sheet shows that we basically have plenty of assets and we've got a lot of money if they do take a loss again this year. Now, I don't actually use Spotify, I use Apple Music, and Apple Music is is essentially the next competitor down to Spotify. I think they have around a 19% market share in the online streaming or music streaming service sort of industry. And given that Spotify is at 35%, there's a pretty big gap that Apple need to close. But given that Apple don't really sort of work on Android phones, that's where Spotify can come in and be like, yeah, we can work on Android or we can work on the App Store. And so therefore Spotify will always end up being the better one. There is also Amazon Prime Music, but I don't, that doesn't really appeal to me unless I have an Alexa, which I do have one, but I don't use it. Now, looking at the technical side of things, we did peak at 388 in February, which would have given it, at the time when we did hit this level, that would have given it a market cap of around 72 billion, which is quite a lot. We then fell, and I remember this fall in February. We bounced, we hit that resistance, and then we bounced again. And luckily in June, I think it was around the 14th of June, we broke that resistance and we tested up here, and we just in last week actually tested those lows, or the trend line lows again. We've bounced on Friday, and looking hopefully at this week, and given that it's earnings, I would like to see the stock back up to around 300 at some point in the next 2 weeks. That represents about a 14% increase from its current price. And overall, it is up 24% so far from the lows in around May. So it's jumped 24% in about six or 7 weeks. And so I reckon that it could do that again. So essentially I would be targeting in the next couple of weeks throughout earnings. I'd look for 300 at some point here. Now 300 is going to be a bit of a tough resistance anyways, because you've got here, which when the original resistance touch was hit twice, and you had the downward resistance. So 300 is going to be tough. But if we crack 300, I think that we're going to go back up, and I'm pretty sure we will. We probably will retrace back from that back to there, and then at some point back in Q3, Q4 of this year, I'd like to see the stock climb back up to them highs, and I think it's going to do that. I think that we will get back up to that 380, 390 share, 72 billion valuation. And that is also one of the reasons that I think that is also fine, is because when we look at turnover and profitability, turnover is around, it will be probably somewhere in the region of around 10.2 billion. On a 72 billion market cap, you're valuing it probably 7 times revenue. Now, normally you don't value companies based on revenue, but this is the markets and investors see what they want to see. And so I wouldn't probably want to go against that. And revenue is going to increase. Seven times on its revenue is okay. I think that it's very possible. Normally when you're doing that type of stuff, you base it on profit, but if we was basing it on profit, then it's insane. So the PE ratio of Spotify is a bit crazy. But ultimately, I think that we're going to get a test in the next couple of weeks to around 300, which is 14%. We come back, and then back end of this year, we head towards that 400. 350 will be your first minor resistance. A break above that takes you up to that 390, and then 400. Now, going further on and actually looking for the future of the stock in terms of potentially holding this for a few years and looking at the monthly time frame, I think that we could get to 500 per share. 500 would be my sort of long-term target, and I'm basing that on because it's a psychological number really, and I know that turnover is going to just increase because they've got the monopoly in this sort of market. 35% market share, it's really good to have. And so therefore, long-term, I'm looking for 500. At some point this year, I'd like to see the highs touched again. I think it's very possible, and so that is pretty much it. Now, in terms of Minipip as a company, we're going to be looking at some more stuff this week as well. So if you like the channel, please subscribe, please like, help us out. This week we'll be looking at MasterCard and Visa, doing a head-to-head on them. And we're going to look at some other shares as well, especially with us going into earnings season. It's going to be very interesting to see which companies do well, which companies do bad. I'm a big buyer of tech, so Apple, Amazon. I wouldn't try shorting any of those. I think that the Nasdaq, for instance, is going to go up to around 16,000 at some point in the next 6 to 9 weeks. Spotify is a tech company, so it's part of that, and so therefore I think, going forward, it is a bullish case, and that is my opinion. Thanks for watching.